Hello to any of those on standby. We will be starting the presentation momentarily in the next couple of minutes at 11 a.m. Eastern. Thank you.
Muted.
Hello, everyone, and welcome to today's session on the new lease accounting standard ASC 842. My name is Jesus Socorro, and I am the managing principal of MBAF's Risk and Transaction Advisory Practice. I want to talk a little bit about our practice. Our practice is comprised largely of former Big Four professionals with meaningful SEC, PCAOB, and transaction experience, helping organizations address their risk and transaction needs, including from an IT perspective, such as cybersecurity and data privacy. Our goal is to be able to serve you in multiple capacities, and we recognize the combination of skill sets and individuals that are required to provide you with your business advisory needs. As a seasoned, accessible, and well-coordinated team, we execute efficiently and with a high level of quality. We have extensive experience with highly complex technical accounting matters, and we've worked successfully with all of the Big Four and other large audit firms, including working with their respective national offices. Our experience encompasses process improvement, IT risk, SOC reporting, internal audit, Sarbanes-Oxley compliance, SEC reporting, quality of earnings reporting, transaction integration, IPO readiness, technical accounting, project management, and enterprise risk management. I want to introduce Emma Florea and Trevor Fu, who are going to be the two lead presenters today. Emma Florea is the director in our risk and transaction advisory practice, and she heads up our practice for the New York region. Emma previously worked with Ernst & Young. She's been with us for about 4 years, and she helped launch this practice at MBAF. Has been instrumental since then, opening up our practice in New York and leading the efforts there, as I mentioned earlier. Trevor Fu has been with MBAF for a while. He used to work at a bank before that. He's a director in the IT part of our risk and transaction advisory practice. And Trevor has a lot of familiarity with software selection, databases, some of the IT elements that we've encountered in assisting clients implementing the new lease accounting standard. So today we'll provide an overview of this new standard as well as key considerations for the transition and implementation of it based on lessons we've learned from companies that are currently in the process of implementing the standard. We are assisting companies that are large and globally dispersed in scores and scores of countries. And we've also taken on projects that are of a much smaller scale. We've had projects where companies select a certain type of software. Others choose to do things with a database, and even some, including publicly traded, that have elected to use spreadsheets to abstract some of the data as part of this implementation. So public companies that are calendar year end need to implement the standard effective January 1, 2019. Private companies calendar year end would be January 1, 2020. So I want to go through a few housekeeping points here before we officially kick off. If you have any questions during the presentation, please type them into the question box in your control panel. We will try to address as many of these as we can during the presentation, and we will also have some time set aside for questions and answers at the end of the presentation. Today's slides are available for download, and also a recording of today's presentation will be made available after the webinar in case you'd like to revisit the presentation or share it with others. Relative to CPE, or continuing professional education, unfortunately, CPE will not be offered for this webinar. For those of you who may have taken part in our revenue recognition seminar, I talked a little bit about this at the end of that presentation and discussed that we were in the process of being able to offer CPE on these webinars and hopefully some webcasts maybe in the future. So now we'll begin our presentation. And so Emma, to start, could you give us an overview of the leasing standard?
Jesus, thank you for that introduction. To start off our presentation today, I wanted to give a little bit of background as to why topic 842, or the new leasing standard, was developed. This new topic was developed to provide financial statement users with more information about an entity's leasing activities. Under the new standard, lessees will recognize all leases, including operating leases, with a term greater than 12 months on their balance sheets. Both lessees and lessors will be required to disclose key information about their leasing transactions in much greater detail than the existing guidance. And we'll cover some of these details in our next slides. As Jesus mentioned, the new leasing standard will be effective for interim and annual periods in fiscal years beginning after December 15, 2018. All other entities will apply topic 842 for annual periods in fiscal years beginning after December 15, 2019, and interim periods in fiscal years beginning 1 year later. We expect this new leasing standard to affect really all organizations across all industries. It is not unusual for a large corporation to have hundreds, if not thousands, of leases. These frequently involve not only real estate leases, but also equipment, automobiles, and other industry-specific leased items. The effect on lessees in particular will be direct, affecting both investor and analyst expectations for those of you working with public companies, and potentially also compliance with contractual covenants. For lessors, the new guidance may lead your customers to request shorter lease periods or different terms and conditions. Lessees with operating leases will likely increase their reported assets and liabilities, sometimes significantly. However, the lease expense and reported cash flows will usually not be substantially changed from legacy US GAAP, meaning topic 840. Lessee accounting will require new significant judgments and reassessments at lease commencement and also during the lease term, which will require changes in processes and internal controls. In addition, and this will be covered further by my colleague Trevor, IT systems may need to be upgraded or modified to ensure all leases are captured and that lease data necessary to apply Topic 842, including its extensive disclosure requirements, are accumulated. While lessor accounting will substantially remain unchanged, some systems, processes, and control changes will likely be necessary as a result of the accounting changes that will result from Topic 842 and the increased disclosure requirements. Topic 842 requires either a modified retrospective transition with the cumulative effect of transition, including the initial recognition by lessees of lease assets and liabilities for existing operating leases as of either the effective date, using the effective date method, or the beginning of the earliest comparative period presented, using the comparative method. Under the effective method, the entity's comparative period reporting is unchanged. Comparative reporting periods are presented in accordance with Topic 840, while periods presented subsequent to the effective date are presented in accordance with the new leasing standard Topic 842. In contrast, under the comparative method, the entity's date of initial application is the beginning of the earliest comparative period presented. The Topic 842 transition guidance is then applied to all comparative periods presented. For example, if a calendar year-end public business entity adopts Topic 842 using the comparative method, then the following dates, which we covered in our previous slide, would be effective. Under either transition method, the standard includes certain practical expedients to ease the burden of adoption on preparers. The three practical expedients are as follows. There is a package of practical expedients whereby the all or nothing approach can be adopted, meaning an entity may elect not to reassess whether expired or existing contracts contain leases under the new definition of a lease. An entity may also elect not to reassess whether the lease classification for expired or existing leases, and also an entity may elect not to reassess whether previously capitalized initial direct costs would qualify for capitalization under Topic 842. As I mentioned previously, these three elections may be all selected at once, but you cannot only pick components of this package of practical expedients. The new guidance also provides a practical expedience in relation to the use of hindsight. An entity may use hindsight in determining the lease term and in assessing the likelihood that a lessee purchase option will be exercised, and also for lessees in assessing the impairment of right-of-use assets. The third practical expedient relates to land easements. An entity may elect not to reassess whether land easements meet the definition of a lease if they were not accounted for as leases under Topic 840. Each of these three practical expedients may be elected separately from the other two practical expedients. However, again, keep in mind the package of practical expedients we covered first must be adopted, including all its components, or not at all. These practical expedients should be applied consistently to all leases, meaning all leases for which the entity is a lessee or a lessor, for leases that commence before the effective date. Next, we will cover differences and changes in the scope of ASC 840 compared to the new standard ASC 842. The board decided to fundamentally retain the scope of the legacy leasing guidance and its new leasing guidance, which means that there are only minor differences in scope between Topic 842 and Topic 840. The scope of Topic 842 is substantially the same as Topic 840. Both topics' scopes include leases of tangible assets, long-term leases of land, subleases, and sale-leaseback transactions. Sale of an asset with a seller-provided resale value guarantee. Before the adoption of Topic 606, revenue from contracts with customers, arrangements in which the seller of an asset provided a guarantee of the asset's future resale value to the buyer were accounted for as leases by the seller, regardless of whether the buyer has to return the asset to the seller to receive a guarantee payment. Under Topic 842, a seller resale value guarantee does not necessarily preclude accounting by the seller and therefore does not require the seller to account for the transaction as a lease. As a result, some transactions involving seller resale value guarantees that are accounted for as leases under Topic 840 will no longer be accounted for as leases once Topic 606 on revenue recognition is adopted. An arrangement in which the seller has the right or the obligation to reacquire the asset may be accounted for as a lease by the seller depending on the terms of the repurchase agreement. The arrangement would be accounted for as a lease if the seller can or must repurchase the asset for an amount that is less than the price at which the asset was sold, unless the contract is part of a sale-leaseback transaction. A vendor, or for example, a supplier, with an arrangement of this nature will need to consider the guidance in Topic 842 and also the repurchase agreements guidance in the new revenue recognition standard, Topic 606. Topic 842 is an inclusive standard, and it applies to all leases, including subleases, unless there is a specific scope exception. And we'll cover now further specific scope exclusions from Topic 842. The new guidance excludes leases of intangible assets. Intangible assets and rights to use intangible assets continue to be accounted for under Topic 350, goodwill and other intangibles. Leases to explore or use non-regenerative resources such as minerals, oil, or natural gas are also excluded from the new topic. The scope exclusion includes a tangible right to explore for those natural resources and rights to use the land in which those natural resources are contained, unless those rights of use include more than the right to explore for natural resources. For example, the right to explore and also develop the land. Rights to use equipment. Rights to use equipment used to explore for natural resources specifically, however, are included in the scope of Topic 842. Biological assets, leases of biological assets specifically, are also excluded from the scope of the new guidance. This is consistent with the scope exclusion that includes the leases of timber to be consistent with the legacy guidance in Topic 840. The new guidance also excludes leases of inventory, which is a defined term in US GAAP. Therefore, only leases of assets that meet that definition are excluded from the scope of Topic 842. Therefore, the description of an asset as inventory alone does not necessarily mean that a lease of that asset is outside of the scope of Topic 842. For example, sometimes entities refer to a collection of assets such as spare parts as inventory. If those spare parts are depreciable assets, under other accounting guidance, a right to use those assets is in the scope of Topic 842. Furthermore, leases of assets under construction are excluded from the scope of the new guidance if a lessee controls the asset under construction before the commencement of the lease date. The transaction is in the scope of the sale-leaseback guidance. Topic 842 includes guidance and examples about when a lessee controls an asset that is under construction before lease commencement, and guidance on accounting for costs associated with the construction or design of the underlying asset in a lease. Furthermore, as we cover specific changes and sections of the legacy guidance that were substantially revised, one aspect of the legacy guidance that was affected relates to build-to-suit guidance. Topic 842 eliminates the legacy US GAAP build-to-suit lease accounting guidance and instead stipulates that a lessee is the accounting owner of an asset under construction when it controls that asset before the lease commencement date. Topic 842 does not consider exposure to construction period risks, nor does it explicitly prohibit certain activities. Because Topic 842 changes the underlying principle to determine when a lessee is the accounting owner of an asset under construction, we expect there will be some different accounting outcomes compared with current US GAAP. When a lessee is deemed to be the accounting owner of an asset under construction, the changes to the sale-leaseback guidance generally make it easier for lessees to remove real estate assets recognized under the construction period from their balance sheets. The transition provisions of Topic 842 will result in many entities derecognizing build-to-suit assets and liabilities that have remained on the balance sheet after the end of the construction period under Legacy GAAP. Sale-leaseback transaction accounting has also been substantially changed under the new guidance. Topic 842 eliminates sale-leaseback transactions as an off-balance sheet financing proposition for lessees. This is because seller lessees will recognize a right-of-use asset and a lease liability in place of the underlying asset, and also any asset financing repaid with the sale proceeds. Unlike legacy US GAAP, the sale-leaseback guidance is the same for real estate assets as it is for all other assets, for example, equipment. Topic 606, the new revenue recognition guidance, is used by both the seller lessee and the buyer lessor to assess whether a sale of the asset from the seller lessee to the buyer lessor has occurred. Purchase options will generally preclude sale accounting unless the strike price of the repurchase option is the fair value of the asset at the option inception exercise date, and assets that are substantially the same as the underlying asset are readily available in the marketplace. This will eliminate real estate sale-leaseback transactions with purchase options from qualifying for sale accounting. In addition, sale and also capital finance leasebacks will no longer exist. A conclusion that a saleback is a finance or sales type lease will result in a conclusion that the sale-leaseback transaction does not qualify as a sale. If the sale-leaseback transaction does not qualify as a sale, both the seller lessee and the buyer lessor account for the transaction as a financing arrangement. The seller lessee recognizes a financial liability and continues to recognize and depreciate the asset, while the buyer lessor recognizes a financial asset, for example, a receivable. If the sale-leaseback transaction does not qualify as a sale of the underlying asset, the seller lessee recognizes the entire gain from the sale, subject to adjustment for off-market terms at the time of sale rather than over the leaseback term, as is typically the result under legacy US GAAP. The buyer lessor accounts for the purchase of the underlying asset in the same manner as any other purchase of a non-financial asset, subject to a requirement to adjust the purchase price of the underlying asset for off-market terms. Next, we will move over to cover the criteria for lease classification, focusing on lessees. At the commencement date, a lease is a finance lease if it meets any one of the criteria below. Otherwise, the lease is considered to be an operating lease. The criteria for a lease to be considered a finance lease is as follows. The lease transfers ownership of the underlying assets to the lessee by the end of the lease term. The lease grants the lessee an option to purchase the underlying asset that the lessee is reasonably certain to exercise. The lease term is for the major part of the remaining economic life of the underlying asset, with the exception that this criteria is not applicable for leases that commence at or near the end of the underlying asset's economic life lease term. Further, the present value of the sum of the lease payments and any residual value guaranteed by the lessee that is not already reflected in the lease payments equals or exceeds substantially all of the fair value of the underlying asset. And finally, the underlying asset is of such a specialized nature that it is expected to have no alternative use to the lessor at the end of the lease term. Next, we will cover the initial recognition and measurement by lessees under the new guidance provided by Topic 842. The initial recognition and measurement of operating leases and finance leases is generally aligned. Under the new guidance, an entity will initially measure the right-of-use asset and lease liability at the present value of the lease payments to be made over the lease term. The subsequent measurement of the lease liability component under an operating lease will involve measuring the lease liability at the present value of the remaining lease payments using a discount rate determined at the lease commencement date. The subsequent measurement of the lease liability under a finance lease will involve accreting the lease liability based on the interest method using a discount rate determined at the lease commencement and reducing the lease liability by the payments made. The subsequent measurement of the right-of-use asset for an operating lease will involve measuring the right-of-use asset at the amount of the remeasured lease liability adjusted for the remaining balance of any lease incentives received, any cumulative prepaid or accrued rents, for example, uneven rent payments, or any unamortized IDCs and any impairment of the right-of-use asset. Conversely, for finance leases, the subsequent measurement of a right-of-use asset involves the amortization of the right-of-use asset, generally on a straight-line basis, over the shorter of the lease term or the useful life of the right-of-use asset, as well as recording any impairment of the right-of-use asset. Therefore, based on these differences in the initial recognition and measurement and subsequent measurement of the lease liability and right-of-use asset, the income statement effect to operating leases will be generally a straight line expense, whereas for financing leases, we'll generally expect a front-loaded expense. As mentioned previously, lessees can make an accounting policy election by class of underlying asset to which the right of use relates to use the short-term lease exception. This exception applies to leases with a term of 12 months or less that do not include an option to purchase the underlying asset that the lessee is reasonably certain to exercise. This election can only be made at the commencement date, and lessees that do not recognize the right of use asset or lease liability for qualifying leases and recognize the lease payments as an expense on a straight line basis. Furthermore, this exception is not available for lessors. In terms of presentation, and we'll also cover in more detail the more extended disclosure requirements of the new guidance. Balance sheet presentation in particular, the right of use asset will be presented either separately or together with other assets. And if presented together with other assets, there will be a disclosure requirement in the line items that include the right of use assets and their amounts. Finance lease right of use assets must be presented separately from operating lease right of use assets. Both the right of use assets are subject to the same classification as other non-financial assets. The lease liability will also be presented either separately or together with other liabilities. And if presented together with other liabilities, a disclosure of the line items that include lease liabilities and their amounts will be required. Finance lease liabilities must be presented separately from other operating lease liabilities, similarly as is the case for right of use assets. And lease liabilities are subject to current and non-current classification disclosure requirements similar to other financial liabilities. As I've noted earlier, the new guidance encompasses expanded qualitative and quantitative disclosures. Topic 842 requires lessees and lessors to disclose more qualitative and quantitative information about their leases than legacy US GAAP. Entities will need to consider whether they have the appropriate systems, processes, and internal controls to completely and accurately capture the lease data necessary to provide those expanded disclosures. The following are examples of qualitative disclosures for lessees and lessors. For lessees in particular, significant judgments and assumptions, such as whether the contract contains a lease, represents a standalone prices for lease and non-lease components, and a discount rate for the entity's leases will be required to be disclosed. Also, information about the nature of leases, such as the terms and conditions of variable lease payments, extension and termination options, purchase options, and residual value guarantees will have to be disclosed. Conversely, for lessors, significant accounting judgments and estimates will be required to be disclosed. Information about the nature of the leases, such as the nature of variable payment arrangements and termination, renewal, and purchase options will require to be disclosed. Also, information about how the lessor manages residual asset risk, including information about residual value guarantees and other means of limiting that risk, will require disclosure. In terms of quantitative disclosures, for lessees, the operating lease cost will have to be disclosed, as well as the amortization of finance lease right-of-use assets and interest on finance lease liabilities. The variable lease cost will require disclosure, as well as the weighted average remaining lease term and weighted average discount rate. Finally, the maturity analysis of lease liabilities will require disclosure by lessees under the quantitative disclosure requirements of the new standard. Similarly, for lessors, under the quantitative disclosure requirements, the maturity analysis of lease receivables for sales type and direct financing leases and of lease payments for operating leases will require disclosure. Selling profit or loss will recognized at lease commencement, and interest income for sales type and direct financing leases will have to be disclosed, as well as operating lease income and variable lease income. One important definition to consider under the new standard is the inception versus the commencement date definition. Under topic 840, the initial measurement date of a lease, that is the determination of the discount rate for a capital lease and the assessment of lease classification, occurred at contract inception rather than at the commencement date. The recognition date for leases is consistent between topic 840 and 842, commencement date. However, because inputs such as the fair value of the underlying asset and the lessee's incremental borrowing rate might be different between those two dates, entities might reach different conclusions about initial measurement and lease classification for some leases using the commencement date versus the inception date, all of which will impact the initial transition disclosure requirements and overall the qualitative and quantitative ongoing disclosure requirements. Finally, we move into some implementation considerations, some of which will be covered also by Trevor and Jesus in their remarks. As part of the implementation requirement, the company should consider the types of financial impacts that might be encountered by the company. As a starting point to implementation, companies should consider what types of leases exist in their organization. What types of contracts does the entity have that could be affected by the revised definition of a lease? Has the company considered how the change for the existing processes will impact the organization? Has the company determined whether all the required information will be available or can it be gathered in a timely manner to comply with the new disclosure requirements? Finally, there's the impact to the financial statements and how certain performance metrics of the company might be affected. Jesus, I will pass this back to you at this point so that we can continue going through transition impacts and organizational and system impacts that we've encountered as part of our experience as part of these implementation projects.
Thank you very much, Emma, for that overview of the new accounting guidance. That's a lot to take in. And, as a general guideline, I think our position is, if you have 100 leases, at least 100 contracts or so, you should really evaluate the need for some kind of a lease management solution, particularly because managing the process manually outside the system could be really, really cumbersome to do. We've got, as I mentioned, I think in my comments at the beginning of the presentation, we've got clients that have a variety of software packages, and there are a lot of them out there now. Obviously, a lot of companies, not just your traditional lease administration companies, but a lot of other boutique shops are coming out with programs because They know that companies are running around trying to get this set up in-house. So, so a lot of companies do have that. And as I mentioned, we've got some that are using databases that they're either creating internally, or they have firms that are doing it for them. I know we've been involved in one large client of ours in that process, where there's been sort of a database that serves as an intermediary IT solution as the software selection process takes place. I think, and I did mention too, we have actually public companies we know of that are using Excel, and I think it's fine even if you have, if you just have a handful to use something like Excel. I think the issue there is really understanding the risks that you face, like in any data, in anything you use Excel for in today's world that works its way ultimately into an accounting, a GL or accounting program of some kind. You have the risk, obviously it's great from a formula perspective and ease and things like that, but the risk of manually inputting things wrong and the cascading effect of those errors that can go on, and potentially even with immaterial errors initially that build up over time, there just in general is a lot of risk with just doing it on Excel. So unless you have extremely tight controls around it, that should really be just a last resort. Trevor, can you walk us through some of the considerations for the software selection process and what companies can expect during this process?
Absolutely, Jesus. Thank you, Emma, for that introduction. So some of the points that need to be considered when selecting or looking for a software, first will be, as Emma mentioned at the very end, regarding the types of contracts that you have, which would impact the number of leases. Some of the difficulties we found some of our clients were encountering in having a good understanding of how many leases they may or may not have was fully understanding those contracts, or even understand the concepts of master lease agreements, or whether or not they had embedded leases also there. Another point of consideration would be how well does the software that you're looking at will integrate, or is it compatible with what you're already using for your financial ERP system. Of course, there's the cost factor would be another point there for consideration in regards to what you're looking for and what's suitable for your environment and budget. What we've seen in some of the software that we've looked at in regards to some of our clients, it could range anywhere from around $75,000 to $250,000, and that's dependent on the type of the number of leases that those clients had also. We were looking at clients within this range that had really high number of lease volumes. So to compare, around 4,000 leases, to give you an idea. Another point of consideration would be the timeline that the vendor would be able to provide you for migrating your data or implementing the software. Does it fit your existing or your current needs and timeline also? Another factor would be, a point of consideration would be fully understanding from the vendor whether or not there are aspects of their application that's still in development. As you know, many of these applications or software came either out of ERPs, vendors who have financial ERP systems, or vendors who had lease management systems. So each of them are trying to develop a piece that they did not have. So in the case of the financial ERP, they did not have the lease management portion of it, so they're trying to get that in place. In the case of the lease management applications, they're trying to get the financial accounting parts of their application in place. In one of the software that one of our clients selected, they did not have the accounting part fully built up, but they provided the necessary guarantees in writing to the client that they would have it before a certain deadline, which they did deliver. So that was taken into consideration. They actually went with them mostly because of the cost point. In regards to what Jesus was saying about spreadsheets, so looking at the different options that you have, yes, we have clients who did choose to go with Excel spreadsheets, and given because 2 points, they had very low number of leases. Secondly, they felt they had the proper controls around those spreadsheets that they will be able to manage it. and they were waiting, holding out ultimatums to see if their financial ERP will come out with a solution for them somewhere along the line, down the road also. So those are additional factors. Of course, you have the lease software that's available, which there are many. But another point of consideration would be, how do I get my information into that software? Is there a process for migrating it, or do I have to enter every single lease into there manually? So those are additional factors. Another factor will be a cost for that additional implementation, which we'll talk about later on also. And I think those are the points of that we have for consideration. Jesus.
Thank you, Trevor. I appreciate that. And I guess one thing too in the software selection process, just I want to talk about implementation, but just to kind of kick it back to you for a second here, when we think about SOC reports, right, that companies would have to obtain, we usually look at that in the context of the external auditor requiring it and whatnot, but it's really responsibility of the management of the company from the perspective of ensuring that the appropriate controls are in place, and in a case like this, controls being in place at a service provider outside of the company potentially here, right? So what can you talk a little bit about the considerations on SOC reports that software companies have, maybe some of the holes that we've seen and things like that, and particularly companies that are, have material leases and are reporting, and their auditor is also reporting under section 404A and B of Sarbanes-Oxley with respect to controls. Can you talk a little bit about that?
Absolutely, Jesus. So that's a really good point, because many of the solutions that are currently available are hosted solutions by service organizations. So if you're a public company, you're trying to get an understanding of what kind of controls they have around their processes and around the application, primarily around the ITGC's controls, which will be manage access and manage changes, but also around how the business processes, which is one of the key aspects that we've seen many of the SOC reports are deficient in. They don't have controls around how the processes are, how they ensure the processes are complete and accurate. They're just looking at it from an IT perspective rather than from a financial business process perspective also. In some cases, we've had to go back to the vendors and suggest to them to include controls around the processing, primarily around reports that their clients will be pulling out of those systems. How can they validate those reports? What kind of process they have in place to validate the information in those reports that they're using for their financial processing in-house, whether or not it's complete or whether or not it's accurate.
That's a good point, Trevor. Yeah, and I think too, potentially as a last resort, if the report isn't there, is having audit rights where the company can go in and do their own work. And a lot of times there's reluctance, maybe because either the software provider's a larger scale and doesn't want to do that for all of its clients and whatnot. But that's obviously one of the considerations there from a company perspective. So Trevor, once a software has been selected, okay, the company says, okay, this is the software we want to go with. What are some of the considerations you can share with us from an implementation standpoint, given your experience and kind of what you're seeing out there?
So from an implementation perspective, often we want to know, how is it that we will be able to get the data in there? What are our options that we have available to us to migrate the data, especially if we talk about large volumes of leases? You want to try and minimize your effort as much as possible. Often what we've seen is vendors will provide templates where their clients can actually use those templates to gather and collect the information, and then they themselves can import those templates. In some cases, we've seen where the option to import those templates or the data by yourself does not exist. It requires additional costs on top of the application costs, where you have to pay for customization to implement that information in bulk. So it's good to know that up front and work with your vendor that you've selected, or even know before you select the vendor, whether or not that's something you want to go, that's a path you want to go down, especially regarding the costs, because they could add up. Um, one scenario that we actually ran into with one of our clients is that they had a very specific ask that they asked us to develop a database for them and help them to collect the information, since they were looking at approximately 6,000 leases at the time. They wanted to be able to make sure that they went through that process of collecting, doing their data extraction properly, capturing all the required data points, and having a very clean set of data and have controls around the quality and the completeness and accuracy of that data before it's actually migrated into their lease accounting software. It was a very tedious process, but it showed that it was very valuable in the long run, because we were able to identify a lot of exceptions and a lot of issues that we would have struggled with if we had gone directly to the application, such as how to handle a master lease agreement or how to handle embedded leases. And of course, they were a multinational organization that had all over around the country where they would have a different approach to the same process. So again, exceptions, how to handle and capture those exceptions was very beneficial for us.
Thank you, Trevor. Yeah, and actually around the country and around the world, in that case, if I recall. So also, what about changes? We talked about, I mentioned, and you talked a little bit about controls from a SOC report perspective, where you have controls that reside outside of the company, and management doesn't really have sort of day-to-day oversight. So, they rely on controls that are outside, and usually there's you have an auditor that reports on those controls independently and all that. What about controls, sort of I don't want to call them basic, but I guess to some extent basic core controls that are expected as part of transition implementation process that the company would have in-house, completeness and accuracy and things in the data gathering effort and sort of going forward. Can you talk a little bit about that?
Absolutely, Jesus. So in regards to some of the controls that would not be covered maybe in the SOC report, or even it might be covered in the SOC report, but then again pushed back to the end user as part of the complementary user entity controls. And again, and I mentioned this very briefly, quickly earlier, it's in those three IT buckets where manage access, so how a user is provisioned, decommissioned, access is reviewed, access is granted and monitored. Then manage change, how changes to the application, whether it's to the application structure, application reports or configuration within the application, how are those changes managed and tested and validated to ensure that they continue to provide accurate and complete information. Again, the third bucket would be operational. How is the availability of the system and how jobs within the application are managed. If there are interfaces between your lease accounting software and your financial ERP system, if there are two different systems, how are any jobs between those applications managed and monitored to ensure that they are running as scheduled, and if there are errors, those errors are being resolved and corrected in a timely manner. Again, looking specifically at reports that will be used from a financial nature, again, looking at those reports and making sure that there are controls around changes specifically to those reports. Yeah, I think that's well. Let's talk a little bit about controls around the data extraction process. Again, it comes back to completeness. So how do we know that we're picking up every single lease that we have in the organization? Many times we go out to clients and we ask them more or less how many leases you have, and the question is, there's really never a very clear answer to that from any client that we've gone to so far, simply because no one really has considered all the possible leases as yet. In some cases, they may have leases that they've really never thought of as leases, such as, for example, in one case in a hospital where they were being provided diesel supply, not diesel, some kind of specialized biofuel that they were being given, and that fuel was they were purchasing that fuel. However, it came with very expensive equipment that was leased to them. which they did not really consider those, and they had them different types of equipment similar to that scenario throughout the organization. It's probably easier to look at land leases or property leases, and those are usually better identified. But when it comes to equipment, that's where the challenge usually comes in. So looking at the controls around how do we making sure that we are capturing a complete inventory of our leases would be another control to look at. And it's probably more so a business process control, but it does impact the technology, information technology controls, because how do we know that we're getting all the leases imported or captured in the software would be ultimately the question that we would need to ask and have answered.
Thank you, Trevor and Emma. So yeah, it's this is for companies. If you're publicly traded and you're a December 31 year end, you're definitely behind the 8 ball. I would say that you've got to really get your ducks in a row very quickly. If you're an off-calendar year end, I gave the example at our last webinar with RevRec, which is all essentially a year behind this one. There was an instance with a large publicly traded company that was an off-calendar year-end company, a November 30 year-end company in particular, that essentially had almost an entire year to implement this. So there are instances where you can be publicly traded if you're off year-end, you still have some time. Private companies, again, following year January 1, 2020, a lot to digest. I mean, we talked about software selection, and this is not the forum to discuss pricing and things like that, but as you look through it, one thing that companies may see that will be pretty consistent among the various software providers, at least in my experience and in our practices experience, is that the leases that relate to real estate would generally be a higher rate, just because of the information that would be required to input. And I guess the the math behind a lot of that would take place as compared to leases of copiers or equipment, things like that. So you generally get higher pricing. A lot of them do it per lease, and there's certain number of leases, and then pricing can change and be variable after that. But you'll generally see that real estate leases are more expensive. We didn't talk too much about embedded leases, but I know that's also one of the things to consider. I know servers that could be off-site. I know many times there are examples that are used. If you look at literature and you can do research in the internet, there's there are a lot of publications out there regarding embedded leases and some confusion. And one thing to keep in mind too is that really, if there's a determination, if theoretically a determination had been made previously that something did not constitute a lease, you have to keep in mind that really you would, if circumstances didn't change, you shouldn't come to a different conclusion. So I think that's one of the healthy discussions I think that companies will be having with their auditors is, well, I'm now having to look at this as an embedded lease, and in reality, we had looked at this before, or should have looked at it, should have subjected it to being audited, et cetera, and conclusions were made. So we want to make sure to vet all those things on the front end as well. So Emma, if there's any closing remarks in your section.
Moving from the guidance you just covered related to embedded leases, we actually have a question which is directly related to that, and I think you provided a great example of the servers located offsite. So the question is, does a lease exist if a supplier has physical possession of or operates and maintains an identified asset? And the new guidance contemplates certain situations where the supplier retains possession of the asset and typically operates and maintains the asset. Under the new guidance, the answer to whether a lease exists is it depends. So the new guidance provides several illustrative examples. One in particular includes a scenario where a customer leases a power plant that the power plant owner, that is the supplier, controls physical access to, operates, and also maintains. Therefore, it's clear that that a lease can exist in such circumstances based on the guidance provided by the new topic. In that particular example, The customer controls when, whether, and also how much electricity that power plant produces, and those how and for what purpose decisions most significantly affect the economic benefits that will be derived from the use of the power plant. Again, going to that particular example where you're leasing a power plant that's continues to be controlled by the owner. A customer may have similar rights to control the use of an identified factory, for example, or dedicated production line in some contract manufacturing scenarios. The factory or dedicated production line may be operated, maintained, and controlled as to physical access by the manufacturer. However, the customer may have the right to control the economic benefits derived from the use of that identified asset by virtue of having the right to dictate when, whether, and how much the factory or the line produces. For example, a factory or a dedicated production line may comprise integrated specialized equipment for the production of the customer's product and may only produce for the customer's product on the basis and only to the extent of the customer's purchase orders issued at each month or quarter end during the contract period. As another, going back to the example you were touching on, Jesus, in the guidance, the fact that the computer server in the example provided by topic 842 is leased does not depend on the fact that it resides at the customer's premises. A customer or specialized server maintained at the supplier's premises could also be an identified asset, and the customer could be deemed to control that asset if it had the right to direct and change, for example, what software the server would host and what functions it was configured to perform throughout the period of use. In more complex scenarios, the asset owner and a customer may each have substantive decision-making rights. For example, the contract manufacturer in the factory production line discussion that we discovered may have the right to decide when to operate the factory or the line. That is, the manufacturer may receive orders from the customer dictating the total quantity produced, but the manufacturer will have the flexibility to decide whether to produce those orders immediately by running the factory or the line at its maximum capacity until the order is fulfilled, or just continue to run the asset at its normal capacity. In that type of scenario in particular, where there's a mix between the decision-making capability of the customer and the supplier, we would generally consider decisions about when to produce that output, which the manufacturer controls, as being less relevant than decisions about whether to produce that output and how much of it to produce, which the customer controls. And in some cases, the customer may also be able to implicitly control the when, as well as the whether and how much decisions, if it can, and in effect, be able to implicitly dictate the level and timing of production by its orders. For example, the customer can issue purchase orders of quantity or subject to a deadline that overrides the manufacturer's normal right to decide when to fulfill those customer orders. Clearly, significant judgment will be required in these types of scenarios, including very careful consideration of which decisions each party controls and which of those decisions are most relevant. For example, which decisions most significantly affect the economic benefits that can be derived from use of the asset.
Thank you, Emma. See if there's any additional questions in the queue.
We do have an additional question, Jesus, in relation to the unit of account for lease identification. The question asks, is the unit of account for lease identification each separate lease component or each identified asset? And the answer to that is it's generally each identified asset. The new guidance states that after determining whether a contract contains a lease, an entity should identify the separate lease components within that contract. Therefore, the entity identifies the leases that exist before identifying which leases are separate lease components. In discussions and interpretive guidance provided by the FASB staff, they stated that an entity shouldn't evaluate only whether components of a single integrated asset are separate lease assets. That is, an entity should not break apart a single integrated asset, such as, for example, as an airplane, a ship, or a building, and evaluate lease identification for those assets that were integrated to create the single asset. several examples to this particular point are included in the subtopic as well.
It seems like we've covered the questions. I don't think it looks like there's nothing else there. So Emma, Trevor, thank you again so much for the great presentation today. I encourage the audience to contact us with questions if they think of anything afterward, or if there's anything with which we could help related to leases or anything else that our advisory practice can do. We'll have some of our contact. I think our contact information is on the slide here at the end. So thank you, everyone. We appreciate you being here. Thank you for joining us, and we will see you next time.
Thank you, everyone.
Thank you all for joining us today.